Hi, this is Jack Foley here from individualtrader.net. Just with an update on what happened in the markets this week, predominantly the S&P 500. Hard to believe, but for the S&P 500 to bottom on the 23rd of March at under 2200 to now be trading at practically 2800 really took many people by surprise, especially when you saw the carnage in many industries over the past few weeks: the hotel industry, the restaurant industry, the airline industry. Also, when you see those unemployment numbers in the US, but it just goes to show you that the narrative since we bottomed on the 6th of March in 2009, where basically the Fed adopted a Keynesian approach to how it wanted to manage the economy with respect to controlling the money supply. The narrative still holds true, which is don't fight the Fed. Again, the Fed has exploded its balance sheet past, I think, 6 trillion now. But again, it's saved the day, so to speak. Yeah, the debt is going through the roof. But if this rally continues, if we take out 2880 on the S&P 500, we turn the 10-week moving average up, well, then we can confirm an intermediate cycle low in the S&P, which looks and sounds absolutely surreal and not true, but we trade and invest what's in front of us, and this is what we're seeing in front of us. And this is and I've said this to subscribers this week, this is the power of the Fed's printing press. I'm not going to name these individual stocks, but a lot of individual stocks came into this crisis, this double punch crisis of the coronavirus and the crash in the oil price, with desperate fundamentals. And I'm not talking about the airlines and companies like that that were just highly leveraged and were just basically shut down so they couldn't fly anybody anywhere. I'm talking about other companies that were just massive debt, negative earnings, negative sales growth, etc. Well, even these stocks have rallied over the past week or two since these stimulus, the results of these stimulus and this money printing has been reflected in asset markets. So yeah, there's every chance that we're going to get a V-shaped recovery here, which sounds surreal, but which could very well happen, and it will happen if the market gets some help from the coronavirus with respect to the curve flattening in many Western countries. The case with in Europe, in a lot of the European countries already, you see the cases coming down. The US is not there already, but that's going to be one of the big countries once we can see the slope coming down there on the far end. Well, then the market is going, as it is a predictive indicator, again, is going to look at that as bullish and probably going to rally the markets again. So I think this, you need to be, I love this line, which is where people, every time you get something like a black swan, you have these doomsday people come out and say that, the markets are going to pot. And, I did think, and I'm going to hold up my hand here, I did think, and okay, it's still a possibility, but lessening by the day, that we would at least test the lows. We would at least test the lows that we saw there at the back end of March. But if this rally continues, well, then that will not happen, and we will get our V-shaped V-shaped recovery. But what I wanted to say about the doomsday people, that the market is going to roll over, massive bear market for a decade, these people forget that the stock market rally that we have had from 666 on the 6th of March 2009 in the S&P to well over 3,000 up to a few months ago, that has just not been induced by money printing. That also has been induced by, you know, real investment and real progression in markets such as semiconductors, technology. You know, you've an array of industries within the technology sector: artificial intelligence, autonomous cars, green energy, renewable energy. There is massive industry happening in these industries, massive growth happenings, and you can't just dismiss all of that just because of this 1-2 punch of the coronavirus and the crash in the oil price. So precious metals obviously should continue to do well, but they are just going to do well because it's a byproduct of the dollar doing worse, so to speak, in the long term. Probably in the short term we may see dollar strength, because if there's more volatility, people will rush to perceived safe havens like the US dollar and gold, so they could easily go up together. But gold, you know, rallied above $1,700 this week, should rally to its next real point of resistance, which was its September 2011 highs of just over 1900. So yeah, one stock which we wrote about recently is Rocky Brands. They make footwear for for the US, one division. They make it for the US military. They also sell a variety of different brands of footwear, boots, that type of stuff, into retail outlets. And also their top performing division at present is its online portals. It's selling, you know, a numerous amount of product through its online portals. So why we like this stock is because its sales, earnings and margins were all increasing significantly coming into 2020. Now, it's also been deemed an essential business because of who it's selling to. You know, it won a contract there with the US Navy last year, and a lot of it's heavy duty gear. You know, it's probably selling into, you know, people in telecommunications, people in manufacturing and industry. So it's been business as usual for Rocky through this lockdown. In Puerto Rico, they needed to close one of their manufacturing facility out there for a couple of weeks, but in the US, for the most part, it's been business as usual. So yeah, we see this stock at present. RCKY is the ticker, selling at a nice discount at present. So yeah, we'll see what happens there, whether we take a position in this over the next few trading sessions. Okay, I'll see you in the next video.